Today we start with the puzzle. China's market share in the US in the last 5 years has fallen by a huge 10 percentage points. That would seem to matter, given the US is the world's largest economy and also the largest single source of world import demand. And yet, China's global market share has risen. And while the overall value of Chinese exports has fallen, the decline has been mild compared with most other economies. Today, we get into this story of how China's exports have withstood the US trade war. It's a tale of some statistical discrepancies, but also of significant diversification to other countries and into new products. All of this has implications for how we understand China's own economy, but in Asia, also for Taiwan and Korea. In addition, although the US is avoiding importing so much from China directly, we'll also show why, as an advanced economy, it can't remain untouched from the big changes in world trade flows that have happened since the pandemic. Before we get into all of that, just a reminder that this is part of the daily and thematic research we do at East Asia Econ. All our research can be found at eastasiaecon.com, where there's also hundreds of interactive charts that are updated daily and cover every aspect of macro in the region. With that, let's get back to the story. First of all, I think we need a bit of history. So going back a few years to before the pandemic began, and in fact, even to before the Trump administration, and the golden age of Chinese exports looked to have ended. By 2010, the big surge in China's share of DM import markets was stalling, settling at around 25% in both the EU and the US. Then, the stalling happened elsewhere. In 2015, 13.5% of global imports were supplied by China. In December 2019, that proportion was still 13.5%. However, with hindsight, it's clear that 2015 just marked a pause in China's structural export upswing. When the pandemic hit, far from decoupling, the world became even more dependent on China than ever. Even as the initial COVID surge in exports has faded, it's clear that the global market share of China has taken a new step up. This has happened even though China's market share in the US has fallen sharply, by around 10 percentage points according to US data. The last time China's market share in the US was so low was back in 2004. In absolute terms, the value of US imports from China has fallen by more than a third just since 2022. Now, this would seem to pose the puzzle. The US is obviously a big source of external demand, and equally clearly is a market in which China has been losing market share. But despite the reversal in fortunes, China's global export performance looks strong. One response to this would be it's all just statistical noise. And, I think inevitably, there are a lot of data issues. We'll quickly go through some of those, but I don't think they change the underlying picture. So, looking into the data, before the tariffs, US data for imports from China was routinely above Chinese data for exports to the US. However, that gap closed in 2019, and now US import data is below Chinese export numbers. As a result, US import data show a much bigger fall in shipments from China than is evident from China's export data itself. A Fed study in 2021 found that the sharp fall in US reported data was because the tariffs introduced an incentive for importers there to underreport their purchases from China. There's issues with China's export data too, but the upshot is that since 2019, the trend in US-China data is more accurately shown by the Chinese export data than US imports. China's own data and the problems there are partly because of the talk of transshipments, with China exporting to third countries to have products labelled as non-Chinese before shipping into the US. Indeed, this is happening, but on our reading, if it is, it still doesn't look to have been very significant yet. China's exports to Hong Kong haven't risen. The rise in China's share with ASEAN has been smaller than the increase in its sales to other EM countries. Certainly, I think in all of this, there's nothing to suggest anything like the geographic restructuring of Japan's export supply chain that happened after the 1980s. Of course, it could be that non-Asian countries are benefiting from this transshipment trade. Mexico seems to have been the big winner from the trade war, overtaking China to become the US's biggest source of imports. That rise could reflect a shift in Chinese production. However, the evidence for that is also mixed. China is exporting quite a lot more to Mexico now, but its share of Mexican imports hasn't changed dramatically. One further complication in all of this data is Russia, with Chinese firms filling in the gap led by the sudden rupture of Russia with the West. Exports to Russia have risen from around 2% of China's exports before the invasion of Ukraine to around 3.5% now. But in autos, one of the export sectors that has been growing most strongly for China, Russia now accounts for around 15% of China's auto exports. So this Russia angle, I think, is obviously important. Now, I think there's also something more fundamental going on, and that really revolves around the EU, where a large gap has also opened up between the EU's measure of imports from China and Chinese data for exports to the EU. However, both sets show that China's market share has risen sharply. Indeed, trends in China's market shares in the EU and the US, which until 2019 were basically the same, are now the mirror image of each other. The driver of this rapid rise is the increase in China's sales of machinery and electronic equipment. Since before the pandemic, China's market share gains in this sector have amounted to over 12 percentage points. Part of this story is autos, with EU imports of cars from China almost tripling in value since then. However, as a category, that's still dwarfed by EU imports of electronics. At least part of that increase is also related to China's emergence as an auto and more specifically EV producer. Apart from sales of semiconductors and transformers, it's in batteries that Chinese electronics have been making the greatest gains in Europe. The impact of these changes on the EU economy is probably even bigger than these export data alone suggest. That's because unlike in the US, where imports have been flat relative to GDP, in the EU the ratio has been rising, a trend led by imports of machinery and transport equipment. In EM, the trend in overall imports before COVID is less clear. But even before the pandemic, China's market share was trending up, and since 2020, both that and overall import penetration has surged. These trends are most obvious in Brazil, but also can be seen in South Africa. In Brazil, manufactured imports from China rose from under 2% of GDP in 2019 to a peak of almost 3.5% in 2022. So, there's big shifts going on here in trade flow since the pandemic. The most obvious one is China's loss of share in the US, which China has offset by selling more to the EU. China has also made significant gains in EM. All these gains aren't primarily in traditional low-end labour-intensive goods like clothing and electronics, but rather in machinery and autos. Given the current weakness of domestic demand in China, these export gains have cyclical importance for China's own economy. But they also matter a great deal structurally. We've argued before that Japan's stagnation in the 1990s wasn't just because real estate hit a wall in that decade, but also because its export-focused electronics industry did at the same time. The industrial change evident in China is one reason to think China doesn't need to stagnate in the way that Japan did. For those countries that have been importing more from China, there should be benefits, such as a falling cost of investment. But this benefit is likely better appreciated in EM rather than in DM. In the EU, it's clear that policymakers are now starting to push back against Chinese imports. And frankly, given the huge rise in how much Chinese imports have gone up, the only surprise here is that it's only happening now, and that so far it's more limited to around autos. Given the US has managed to avoid the Chinese import surge being experienced elsewhere, it might well be argued that Trump's tariffs are protecting the US market. And that may be true, but it also seems that the US can't completely avoid the consequences of China's move into capital goods. That can be seen in EU data, where the economy is getting displaced by the surge in China's sales of machinery and transport goods are primarily Japan, the US and the UK. Even for the US, it isn't obvious that tariffs have provided much respite for domestic producers. Manufactured imports haven't declined as a percentage of US GDP, and nor has the overall trade deficit in manufacturing narrowed, with China's place simply being filled by other foreign firms. In the US, the big winners are Taiwan and Vietnam. Given that the US is currently on better terms with both, perhaps this means that there has at least been some de-risking of US supply chains. And whatever the implications for the US, it does suggest that Vietnam and Taiwan are emerging from all of these structural change in global trade flows and the dislocation of the last few years in pretty good shape.